joined Bhavik Mehta, Deputy Head of Research at Century Financial. Bhavik, thank you so much for joining us. Let's talk about Goldman Sachs forecast. Do you believe that those forecasts will happen in 24, especially for gold, which was expected to reach $2,300 an ounce?
Right. So first of all, thank you for having me on the show. We have got to understand what is happening with the current global markets. Essentially, everything has been a big dovish bet on the US central bank rate cuts. So the latest FOMC meeting very well guides to at least a minimum of three rate cuts. So we are expecting one rate cut every two meetings. So we have six meetings to go. That has basically pumped up the bullish forecast as far as gold and commodities like copper is concerned. But if we talk about gold, it's a very specific and a very unique case because 2024 when we end the Q1, we've seen two consecutive years of more than 1,000 tons of central bank gold buying. So 2022 as well as 2023, something like 1,050 plus tons of gold was being aggressively bought by central banks led by China, Turkey, and Russia. Uh, Autonomous members like World Gold Council are expecting the trend to continue for this year. So this is something that has really pumped up the actual spot market prices. Now we should remember that this is coming at a time when the ETF from the gold ETFs, the outflow from the gold ETFs have been happening at a record pace. So even for the February month, I believe the numbers from US and Europe have been negative. So it is much of the central bank physical buying that is supporting the gold prices.
Goldman Sachs expected a number of commodities to go up, but stressed that it is important for investors to be selective because the gains will not include all commodities. Why, in your view, this divergence in the forecasts regarding commodity prices? We can talk about revival of industry, lower interest rates, which reinforces the use of those metals in industry.
Commodity space continues to provide a very, I would say, a diverse view. On one hand, we have the ongoing slowdown in the Chinese real estate sector. So fundamentally, at a macro level, if you look at the price performance of key construction commodities like aluminium or even steel bars, they have been trending down this year. Specific cases, if you talk about something like coal, if you talk something like crude oil prices, or even something like copper, those have been more bullish to the individual macro level factors. Copper's example, one of the primary divergent factors has been the closure of major mines in Panama and Chile, which has reduced something like 3 to 4% of the global supply. So we've seen a trend of Chinese smelters, scrambling to get the supplies, and major refining output cuts that are happening across the Chinese smelters. Energy markets, the ongoing demand at the base level demand that is happening has surprised majority of the market analysts because 2023 when there were loud calls of recession, that has now completely dissipated. So majority of the forecasts are now seeing oil prices above the 78 to $80 a barrel. That is the base case scenario. So selective basis, copper demand led by, I would say, still resurgent theme for the EVs because copper continues to act as a key base material. Brent prices, oil prices, these are the buckets of commodities that are providing the opportunities as of now.
What are the factors that could limit the increase of those commodities?
In our view, we see a bigger risk to base metals, starting with copper, because if you're looking at the overall, even the inventory buildup at the Shanghai Copper Exchange, so the inventories are near multi-year highs because Chinese smelters have aggressively stocked up the majority of the imports. So we do not see much of a downside risk for precious metals, but a major, I would say, a macro level risk for base metals led by copper. So gold, we are still bullish despite any uptick in the dollar prices because the world has slowly started realizing that, whether you call that as an inflation hedge or a new asset class wherein it's going to provide a multi-decade high returns, but a majority of the bulk of the buying has been happening from the institutional players and the central banks. So not much of a downside for gold, but much of the macro risk forecast as far as the base metals are concerned.
Thank you so much for your analysis, Bhavik. Mehta, you
Thank
have
you.
joined us, Deputy Head of Research at Century Financial.